market regulatory framework to issue profit warnings and financial results at the same time. Victor Kiprop reports on the regulatory lacuna and how it inhibits investors' ability to act on the information in determining their investment decisions in good time.
Ever ready East Africa's decision to release its results for the year ended 30th September 2019 and issue a profit warning for the same period simultaneously has once again put on the spot the regulatory lacuna around issuance of profit warnings in the country.
When it comes to issuance of profit warnings, the legal framework is very clear that you need to do it in good time so that investors get this information in good time. And sometimes we've seen companies release these profit warnings either on the same day when they are releasing their accounts or just a few days before that.
The American battery manufacturer saw its losses for the period widen by 161% to 303 million shillings, up from 116 million shillings recorded in the last financial year. And while the drop is well above the 25% decline in earnings that listed firms are required to disclose, shareholders, investors and the public only got to know about it this morning.
The law is not very strict on these are the number of days you should have released the profit warning before you release the results. However, as good practice, we expect that managements of listed companies will be aware of these issues which are causing them to issue profit warnings and therefore to issue those profit warnings in good time.
The Capital Markets Authority acknowledges the loophole and its weaknesses in regulating the sector, part of which it says are to blame for the low uptake of capital market products in the country.
The feeling we have is we need to look at our legal framework because companies, our licensed persons and others fail perhaps because of the so many restrictive requirements in certain areas. The cost of compliance seems to be high.
Victor Kiprop, NTV Business.